What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast. And for those listening on any podcasting 2.0 apps that are streaming me sats, it is greatly appreciated. I record at varying times during the week, so I don't get to read all the boosts or anything like that, but they are greatly appreciated. All those 5-star reviews that you have been leaving are also greatly appreciated on anywhere you get podcasts. So be sure to hit that subscribe button to get the next episodes directly to your feed. And if you are watching this on YouTube, you get to see my pretty face. Be sure to give this a like and subscribe to my channel. I've been trying to grow it. It's been growing greatly, and I really appreciate it. So like, subscribe, give the comment. You guys know the drill by now. It allows me to get great guests, and I have one in the waiting room here. I have Gordon Johnson here, who is big shot on Twitter and everything else. So Gordon, how you doing today, man?
Hey, good to be here. Thanks for having me.
Of course. So for those that are in the audience that might not know much about you or your background, why don't you give us the little spiel here? Like, how did you get to where you are today, and what do you do in the space?
Yeah, sure. So, I started off in investment banking. I'm an old guy. I started off on Wall Street at J.P. Morgan in 2001. Did that for 2 years. Moved over to equity research, Credit Suisse, then Bear Stearns and Lehman Brothers. The number of smaller shops, Bank Capital, Aleem, Axiom Capital, Wolf Research, and we were finding a lot of opportunities on the short side. And the problem is when you work for somebody and you have short recommendations, it doesn't last long on the sell side. The sell side is supposed to be, research driven and agnostic to, being positive or negative, but that's just not the case. If you look at the weighting of buy, sell, holds on Wall Street, it's probably like 90% buys. And the reason is because at major shops, be it investment banks driven by investment banking business or, primary research shops where, the real revenue is driven by management access. If you're not positive on companies, you don't get access. And if you don't get access, you don't make money. So I feel like, if you're going to have sell ratings, you're not going to last long outside of having your own firm. So that's why I started GLJ Research in 2018. So I wouldn't have somebody, sitting over top of me telling me that you can't have sell ratings, which I pretty much had my entire career. So that's how I've got where I'm at. We like to do, fundamental bottom up. Well, we like to look at top down opportunities. What I mean by that is find opportunities where we can have a strong view on supply demand, and then from there find specific stocks where we can do bottom up analysis to supplement or help out with our top down. So that's kind of how I got to where I'm at and kind of our focus.
Yeah, for sure. And it does seem like pretty interesting because you started this in 2018, you said. So it's been about 5 years or so. But in those 5 years, the past 3 have been, a little bit wild, obviously, with the COVID pandemic and the stimulus packages, the GME AMC craze. There's been a lot of various kind of events. And now we're kind of in a different macroeconomic time. Like, it seems like there's been a lot of cracks underneath the surface of the economy, but the stock market's been doing kind of well. So let's dive into it there. So, kind of how do you think, I guess, overall macro view, where do you think we're at? And, how do you think we're like shaping up compared to maybe pre-COVID, I guess is the phrase I'll use here, but maybe not necessarily, I guess, like pre-COVID, if that makes sense.
Yeah. So I think there's a big misconception among politicians who greatly influence what the Fed does and the lion's share of retail traders and investors, and that is that the stock market is the economy, and the stock market is not the economy. And in fact, there's been a number of times in history where you've had significant sell-offs in the stock market, yet there was no recession. So I think what's happened is you've had aggressive, extremely aggressive monetary policy and fiscal policy. But keep in mind, monetary is the Fed printing money. Fiscal policy is the government spending money. But the government can't spend money if the Fed doesn't print it. So this all really goes back to the Fed. And you had effectively, when Obama took office and the banks got in trouble, you had, this invention of quantitative easing, which was effectively printing money to buy bonds. And what that has done is it's created the biggest wealth gap / inequality / burden on poor people. And I shouldn't say poor. I mean, when I say poor people, I mean basically the non-rich, which is basically 90% of Americans we've ever seen, right? The reason why home prices are up, since 2008, 300, 400%, yet minimum wage is essentially flat, is because the Fed started printing money to buy mortgage-backed securities, which is effectively printing money to buy houses. That artificially inflates the value of houses, which has essentially pushed an entire generation of Americans, the millennials, out of the ability to afford a house. That's not organic; it's inorganic. So where we find ourselves today is in an environment of extremely aggressive, monetary policy from the Fed. Right? We just had, there was a small bank that had problems, and immediately the Fed resorts to, nearly $400 billion over 2 weeks of quantitative easing. Now, everybody says it's not quantitative easing. I just don't disagree. I just disagree. Instead of printing money and buying it outright, they printed money and lent it out to buy bonds from banks. That's quantitative easing. That money is finding its way into the stock market, as we've seen. Since the Fed did the BTFP, every week the stock market has been up. The problem, though, is this creates significant imbalances and it encourages significant moral hazard. So that said, I think where we're at is, against all that backdrop, you have inflation, right? Core inflation at 5.6% as of yesterday, which is just unacceptable and debilitating to the bulk of people in the U.S., i.e. it just significantly reduces their purchasing power. So the question is, will the Fed be able to continue to get away with this aggressive printing? And I think the answer later this year is going to be no.
Yeah, so let's talk about that then, because it is kind of interesting because like you said, they're going through, some call it quantitative easings, others don't really describe that, but essentially it was like a bailout of Silicon Valley Bank, right? I mean, backing up all their customers' deposits, all that kind of things, and they've essentially come out and said if there's any other banking situation, they didn't outwardly say this, but they kind of hinted towards that they would not allow any depositors any of their deposits to not be insured, whether that's the Fed quantitative easing, as you've kind of described it, or, through FDIC insurance, if that's applicable in those situations. But on the flip side, the Fed has kind of continually raised interest rates throughout this. They've obviously had like an intense hiking cycle, hiking interest rates at a historic pace. And they've kind of, I guess, essentially let the foot off the pedal slightly by doing some 25 basis points hikes in the past couple meetings. And then it seems like the next one is pointing toward 25 basis points. But on the flip side, it seems like the market's kind of calling for a reversal of that and a pivot. So, with that kind of playing out as quantitative easing and almost quantitative tightening kind of going on at the same time, how does that, I guess, in the end play out? Because it seems like they're tightening up money, but they're also kind of, backing it up and, printing it, so to speak.
Yeah. And just to highlight to your listeners, when I say the stock market is not the economy, if you look at the S&P 500, it was down 40% peak to trough in both 1987 and over the 2000 to 2002 timeframe. And in both of those periods, there was no recession. So again, the idea that the stock market is the economy is dead wrong. Now, with respect to where we're at right now, I think there's a very interesting dynamic unfolding. And let me explain what I mean by that. So clearly, the CPI inflation data came out yesterday, right? And that was all the buzz. And I think that there was a very important takeaway there that I think some people may have missed. And so what I mean by that is, the inflation report, if you look at inflation for all items less food and energy, December, January, February, March, December 2022, and then January, February, March 2023, on a month-over-month basis, that number is 0.4, 0.4, 0.5, and 0.4. So it's annualizing at 5%, which is way too high and simply unacceptable, right? Their target is 2, but, sticky 5% inflation will be crushing to the masses. So when you also consider, right, that in the most recent CPI inflation report, the energy component was down 3.5%, yet since March, gas prices are up 7.4%, and April month to date, oil prices are up 10%. It seems like the energy component is reemerging with a vengeance, if you will, with respect to its contribution to inflation. And then looking at the shelter component, which is a big percentage of CPI inflation, it's like, September, October, November, December, January, February, March, 2022, 2023, month over month, you're talking about 0.7, 0.7, 0.6, 0.8, 0.7, 0.8, 0.6. The point is it's annualizing at around 7.4%, which is debilitating. So the point is you have inflation that looks like it's anchored at 5%, with an energy component that was down 3.5% in March, despite the fact that since the beginning of March to today, gas prices at the pump are up 7.4% and oil prices are up 10% in just April. It seems like, you could see the inflation beast, if you will, reemerge in April. And against that entire backdrop, you have a Federal Reserve that currently has $6 billion in excess reserves and reverse repos sitting on its balance sheet. What that means is if they start to cut rates, that money that's sitting on their balance sheet, right? That's money that effectively banks have at the Fed that they're getting, 4.8% on. If the Fed starts to cut rates, banks will take that money out of the Fed and use it in other areas, i.e. buying stocks, buying houses, etc. So if the Fed starts to cut rates, you're going to see a massive increase in M2, money supply, and you already have M2V, the velocity of money, surging the most we've seen in years. So that would create significant inflation. So I think the Fed is between a rock and a hard place with respect to their ability to cut rates. Keep in mind, the market expects the Fed to start cutting rates in July. The Fed's guidance is they're going to go to 5.125% and keep it there through the end of December. So basically 3 months out, someone's going to be wrong. And given we think the Fed is between a rock and a hard place, we think the someone who's going to be wrong is Mr. Market. And clearly that's not priced in.
Yeah, I mean, it has been interesting, right? I mean, we're talking about, a lot of potential cracks in the market, right? I mean, the CPI data obviously is extremely high. I mean, you alluded to, oil and gas, like energy prices. I mean, I just filled up my car yesterday and I was paying $3.54 a gallon. So, and I'm down here in Florida. So that's not exactly normal. I know that the prices like a couple years ago were right around $2. So, I definitely agree with you that I don't think inflation is really going anywhere. Maybe it's becoming the quote unquote new normal that we've been phrase that we've been tossing around here for the past couple years. And yeah, I mean, we're seeing unemployment kind of go up, although it is a little bit lower. Maybe the job market isn't as strong as maybe we're potentially seeing. But on the flip side of things, like you've said, the stock market isn't indicative of the overall economy. Year to date, S&P 500. I'm looking at it now. It's about 8% in the green. And on an average year, that's pretty good for the entire year, and we're only a quarter into it, right? And we've seen other things like growth in tech stocks kind of shoot up astronomical numbers since the beginning of this year. So on the flip side of things, do you think? I mean, obviously, it's not financial advice or anything like that, but if the Fed holds true and the market is essentially like pricing in these rate cuts by July, how does that situation play out as far as the market goes? Is there still going to be, massive amounts of volatility where some things are going to be in the green and whatnot? Or do you think, we might essentially have like a stock market crash if we're pricing in all these cuts and the Fed essentially holds true?
Well, let's address two things, right? So I think there's a big misconception around the jobs market. And let me explain. So the most recent labor report, in my view, was amazing. And the reason I say it's amazing is because the Fed has been hiking rates for roughly a year, yet not much has changed in the labor market. And that is when you compare today's labor market to the 2016 to 2019 feel good times pre-pandemic, job creation is currently running at double the rate of the feel good times. The number of unemployed people seeking jobs is near a historic low currently. And average hourly earnings of non-management employees are still rising at over 5% per year. That's roughly double that what we saw in the 2016 to 2019 feel good times. And then lastly, the labor force participation rate for people 24 to 54 years old is the highest it's been since before the Great Recession. So a lot of people talk and say, well, there's been a lot of tech job cuts. And that's also extremely misleading. And the reason I say that is because if you look at the tech job cuts that have happened, despite that being the hotspot for many of the recent layoff announcements, since peaking in November 2022, employment in the tech sector is down just 1.1%. And it's still up 6.4% from the peak of the feel good times, i.e. 2016 to 2019. And then when looking at unemployment in the tech sector, while it's risen to 3.4%, it rose to 3.4% in March, it's still well within the range of the feel good times. And in fact, if you look at the tech sector jobs, we're now starting to move back higher. So the point is, like, the job sector remains extremely hot. It remains extremely hot. And the problem is that when you have a hot job sector, people effectively, make more money. If people are making more money, they're going to go out and spend that money. And if people spend that money, inflation is going to continue to be supported. So I think that the labor market is indicative of sticky inflation. So that's one thing. I think that people talked about the labor market being concerned. You've had politicians talking about millions of jobs lost, but that's just fear mongering when you look at the data. The job market is still extremely strong. Number one. Number two is if you look at what's happened with respect to the Fed's quantitative tightening, and it's important to remember that they were doing this quantitative tightening, then one small bank, and keep in mind, right, what happened at SVB was completely predictable. And what I mean by that is you look at what, the central bank in Mexico and the central bank in Brazil did, among other emerging markets, or developed markets, if you will. And they significantly raised rates in 2021/2022. And a lot of other countries did as well. Why? Because the Fed told you they were going to start raising rates, and they did that to protect their currency. What happened at SVB was just simply malfeasance and just a massive risk-taking attitude from the executives there. You had a bank that was effectively, operating in very short duration, securities that didn't take any heedance to the Fed telling you years in advance that it was going to be hiking rates. And thus, when rates moved up, the bank got hit. The idea that as a result of that, you had two things happen, right? You had the depositors bailed out, which I think is a slap in the face of, U.S. taxpayers. But more importantly, in our view, you had the Fed come in and create this BTFP facility where they're effectively buying, treasuries from banks that are underwater. And I shouldn't say buying; it's lending money out to them. So they're making assets that are valued at 70 cents on the dollar whole, and that's what I think is effectively quantitative easing. Like, quantitative easing is the Fed printing money to buy bonds. That's effectively what they're doing here. Now, the definitions around how they're doing it, some people will say I'm crazy to say that, but I mean, just look at what happened with the stock market. I mean, the stock market has been up significantly since they've done that. The problem, again, with all of that is they're doing these things which are unnecessary in the face of 5.6% core inflation that looks sticky. When they print money, it creates inflation. So one thing to keep in mind, right, is, since QT started, that was June 1st, 2022, the Fed's balance sheet has come down by $282 billion. The problem is the Treasury General Account, which is the balance that Janet Yellen manages, has increased by $620 billion. So she's nearly, tripled the quantitative tightening that the Fed's done with her own form of quantitative easing. When the Treasury General Account balance falls, that's effectively Yellen going out in the market and buying bonds. So that's putting cash into the market. So she's completely sterilized, everything that the Fed has done with respect to quantitative tightening. So in effect, there's been no quantitative tightening. The problem, though, is the TGA account balance is nearing a level that she's going to have to refill it. Following the drain we saw, the week of April 4th, you're looking at a TGA account balance. I'm sorry, the April 5th drain. You're looking at a TGA account balance of 168 billion. That's the lowest level we've seen, I think, since, let's see here, since 12/22/21. And if you look at the TGA account balance, when the debt ceiling is when that dilemma is resolved, as we saw, right, the last time the debt ceiling dilemma was resolved, Janet Yellen, I think that was around, late 2020, Janet Yellen had to refill not Janet Yellen, but the Treasury had to refill the TGA, meaning instead of buying bonds, they had to go out and sell bonds into the market, which is taking liquidity out of the market. And what happened? The S&P 500, I think, sold off over the next 6 months by 15%. We're near that dynamic happening. So not only are you going to have a Treasury that's draining liquidity from the market imminently, because effectively the Treasury is about to run out of money, which will force politicians to come to an agreement on the debt ceiling, but you're also going to have quantitative tightening, which the last time the Treasury had to refill their coffers, the Fed was still doing QE. And despite that fact, the S&P 500 sold off by about 15% over the next 6 months. So, look, it's hard to say exactly what's going to happen. There's a lot of moving parts, but it looks like we're about to see a significant drain of liquidity from the U.S. markets at a time when you have an S&P 500 index that's up 8% year to date, as you said, despite the fact that the expectation is that EPS will be down 6% in Q1, and cash flow is going to be down 20%. Trading at an 18 times multiple, right? We're at levels that the S&P 500 is at levels, the same levels it was at when the Fed funds rate was 0 versus the Fed funds rate at over 4.5% now. That makes absolutely no sense. So I just think that there's euphoria in the market right now. A lot of people are trading euphorically. And when some of these dynamics start to come into play, I think that you're going to see a sell-off. And the difference between now and before is, given inflation is raging, right, at over 5%. And the Fed has these dilemmas, i.e., if it cuts rates, you're going to see inflation go up even more. I don't think that they're going to be able to come to save the day this time, as they have every time the past, 15 years.
All right. So yeah, there was a lot to unpack there for sure, but I kind of want to get back into the labor market and discuss a little bit of that because you brought up that the labor market still seems like it's relatively strong, right? I mean, obviously, I agree with you there about the tech sector, how the tech sector was a lot of high paying jobs, essentially like people were getting laid off in those tech jobs, but they were able to find maybe even higher paying jobs within 2 to 3 months, and they were already high income earners and. But one thing I want to push back on, and I'd love to hear your opinion on it, is the gig economy, where now we have essentially the ability to where somebody just go on their smartphone, they could go drive Uber, pick up groceries, do some various knick-knack kind of tasks in order to, I guess, remain off of that quote unquote unemployment pay. Do you think that is maybe part of the reason where I don't know if I want to say inflated, but that the job numbers aren't exactly where, maybe they are, maybe they could be. And that, do you think do you take those, I guess, job numbers kind of with a grain of salt because of this, or, just because of the way that they're reported and whatnot?
So if you look at information sector, so tech sector jobs in the US, right? Pre-pandemic, right? The good times from 2015 to 2020, right? Basically March of 2020, you had about 2.75 thousand jobs in the tech sector in 2015 that rose to around, call it 2.9 million jobs in March of 2020. COVID hit, dropped to 2.6. And then post-COVID, we rose all the way to like over 3.1 million. And so we rose to like 3.15. Then we dropped to like 3.05. And in the most recent month of March, we're back up to 3.1. So we're still significantly above where we were during the good times. And in fact, jobs are rising. All right, number one. Number two, you look at payroll changes at establishments. This is looking at, thousands of jobs added / cut. And this is on a 3-month average basis. In the month of March alone, there were 236,000 jobs created, according to the Bureau of Labor Statistics. But on a 3-month basis, over the past 3 months, there's been 1.34 million jobs created. And that's nearly double the rate we saw on average over the 2016 to 2019 timeframe, i.e. 549,000. So on average, on a 3-month basis, from 2015 to 2020, you had 549,000 jobs being added every 3 months. In the most recent period of March, on a trailing 3-month basis, you had 1.34 million jobs added. That's extremely strong, no matter how you cut it. Then we move to, change in all workers self-employed. So this is, all types of work, including those self-employed. This number is sitting at, just under 2 million jobs, whereas on average over the 2015 to 2020 timeframe, this number averaged like less than 1 million. So you're looking at double now what we saw during the feel-good times. You look at the unemployment rate, which, barring the month of February 2020, it's at the lowest level we've seen in multiple decades on a 3-month average. You look at the participation rate of, prime labor force working ages of 25 to 54. It was 83% in March, and we're sitting at, near record low level or record high levels. So people are participating in this labor market. And then you look at, average hourly earnings, which have been coming down, but nonetheless, in March at 5.1% year over year is way higher than, in 2015, it was 2, in 2016, it was 2.5, got all the way in 2020 up to just over 3. And we're now looking at 5. So it's come down, but that wage growth is still very strong. So the point is the job market is still extremely hot. And again, as I said, a strong labor market means consumers are working and making money. And because their incomes are rising, they're spending that money. Thus, given consumers are spending, and the consumer spending trends have been strong as they have, I think that's going to continue to fuel inflation until the Fed makes some progress there.
Yeah, and that makes sense. But with all that, you've kind of alluded to inflation's essentially staying sticky, right? I mean, whether that's because of the job market or various other factors that we've kind of gone through, in a sense, throughout this conversation. And something interesting came out yesterday. I believe it was from the New York Fed, who said that they don't think that the inflation of 2% is going to be anywhere until 2025, which obviously is like a year and 3/4 away. So do you kind of think that as we've been kind of describing throughout this, that inflation is going to be sticky? Do you kind of subscribe to that theory? Do you think that, or do you think like the Fed might be able to get some sort of a manage on the inflation rate that we have right now?
Yeah, I mean, you look at services inflation, which remains sticky and is 2/3 of the mix, CPI. You look at the fact that energy prices are starting to go back up. There's been little investment. We drained the SPR, and the ability to continue draining that is de minimis now. You look at shelter inflation, which over the past year is averaging roughly 7.4%. And you look at the fact that the Fed just infused. They've taken money out, but let me do this. So over the past when the SVB thing happened the week of 3/15, the Fed did 297 billion of balance sheet expansion, or QE. Then the next week they did 94 billion. So that's 391 billion in 2 weeks. Now over the past, over the next 2 weeks, and we'll get data after the close today for this week, they drained 28 billion, they drained 73. So over the past 4 weeks in net, the Fed has done 290 billion of quantitative easing. And the reason that's important is because if you look at the progress they made on quantitative tightening since June of 2022, right? So from June of 2022 to the week of 3/1, they took $571 billion out of the market, right? That's over a half year it took them to take $571 billion out of the market. Then in 2 weeks, right, with any crisis, they infused 391 billion. You understand the problem there, right? Like, these guys have no discipline. This is just reckless activity. And Congress is supposed to have oversight of the Fed, but clearly Congress is not doing their job. In fact, it's been said that a number of people in Congress traded banks ahead of those bailouts, which is just I don't know how else to say it, just corruption / reckless. So my point is, the problem for the Fed though is that they're in between a rock and a hard place. The reason I say that is because you've had, again, Yellen do since June of 2022, or when QT started from the Fed, she's dropped the TGA account balance by 621 billion, right? That's nearly 3 times of the QT that the Fed has done over the same time frame. But her TGA balance is about to go to zero, and when that happens, and she runs out of money, she has to refill that, which will happen with the debt ceiling agreement. And again, the last time she did that, hold on, let me just find out when that was. 1 second. I just want to make sure I'm giving you. Let's see here. Okay, so from mid-December of 2021 to May of 2022, the TGA account balance increased by 906 billion. And that was her replenishing the TGA account balance. And over that same time frame, the S&P 500 fell 17.2%. I just want to make sure you understand what I'm saying here. People look at the Fed's balance sheet, but you have to look at 3 items when looking at liquidity in the U.S. market. It's not just the Fed balance sheet. It's also what's happening with the Treasury General Account balance, which is the Treasury's effectively checkbook, and the reverse repo account. As the reverse repo account goes up, that's money coming out of the market. As the reverse repo goes down, that's money going into the market. So my point is the TGA account balance is nearing zero, right? The last time she had to replenish, again, December of 2021 to May of 2022, where she had to grow that account balance by 906 billion, which was effectively 906 billion of liquidity coming out of the market. The S&P 500 fell 17.2% over that time frame. Okay, so my point is, she's about to have to do that again, right? And in addition to that, when that last happened, the Fed was not doing QT, they were doing QE, i.e., they were infusing money into the market, not pulling money out of the market. They're now doing QT. So my point is, imminently, you're going to have a liquidity crisis in the US, which typically resonates with lower stock prices. Does that make sense?
Yeah, that makes a lot of sense. Which I mean, it is kind of an interesting time though because of what you're saying that it usually correlates with lower stock prices. So I mean, if we kind of like reverse the clock here, we have seen a big jump up in some of the stocks. Specifically, I mean, even the S&P 500 is up over 8% throughout this quarter. And there's a lot of other stocks, and you've made I guess maybe some enemies online with your viewpoints on Tesla and some of these other kind of growth stocks that have essentially shot up throughout the beginning of this year. So, do you think, I guess, that is some sort of delusion, or there's something that, I guess maybe that the market is kind of, I guess, forward looking and essentially just, I guess, trying to reach for something that might not necessarily be there?
No. There's a clear explanation for what happened at the beginning of this year. So one of the things that we look at, so people look at the Fed, right? A lot of people look at the Fed, the ECB, and the BOJ, their balance sheets. But you also have to look at the PBOC, right? The Chinese central bank's balance sheet, the Bank of Korea, Bank of Canada, Bank of Brazil, Swiss National Bank, and Canadian Bank. And when you look at all of those guys and you add them all up, what you'll see is that at the beginning of this year, there was a massive increase in balance sheet at the PBOC. PBOC did 380.2 billion of US dollar balance sheet expansion the week of 1/4/23. And then 4 weeks later, the week of 2/1/23, they expanded their balance sheet by another 206.3 billion. So if you look at the total of all of the central banks that I just mentioned, 6, 7, 8, it's like 11 central banks. In the month of January, all of those central banks combined did $782 billion of quantitative easing. Keep in mind, in the month of December, all of those banks combined withdrew, right? They did 81 billion of quantitative tightening. They withdrew 81 billion. So what happens is when these bank balance sheets expand, right? 782 billion in January of positive, liquidity into the markets, negative 81.2 billion of liquidity in December of 2022. So there was a big, massive expansion of liquidity to start this year. And I think that's why you had this massive increase in all of these risk assets, because effectively what happens is that liquidity goes into stocks, for stating it very simplistically. So then what happened in February? In February, if you add up all those banks' liquidity, negative 218 billion. So I'm just going to pull up the S&P 500 chart. What did it do in February? I don't remember exactly, but I'm going to assume it was down. Let's see here. So in February, for the month of February, the S&P went from about 4076, and exiting February, it was 3970, right? So that's what happened in February. And then in March, with the BTFP from the Fed, you had a net 227 billion of, effectively quantitative easing because of what the Fed did. So, in March, and they started that in the middle of the month. So, the big drain in February, the market was down, it moved down, it was going down even more. And then all of a sudden they did this massive infusion. And basically in mid-March, the market just shot straight up. And so I think that there's explanations for what happened in the market this year. And I think that those explanations are also representative of what happened in some of these meme stocks and money losing slash Tesla like stocks.
Yeah, and so we talked about the growth stocks and kind of the explanation behind what has happened, but it seems like you've been kind of against Tesla for quite some time. So why don't you I guess me, I'm kind of I guess I'm on the fence about Tesla, right? I mean, I see that it's a very polarizing topic, right? There's people that live and die by every word that Elon says. They think that every kind of move that he makes is outstanding, and then on the flip side of it, I hear a lot of bears that say essentially, if you were to price Tesla as like a car company, is extremely overvalued. So, when you look at it, when you look at Tesla, like lay out your thesis for it, and maybe explain why you're short on the stock as a whole.
Yeah, so I mean, the Tesla thesis is actually quite simple. You have a company that is effectively seeing its growth slow significantly. And, despite that fact, I think that last time we checked, I think that like Tesla is valued at more than the next 7 largest automakers combined. Yet on a trailing 12-month basis, they've sold like 4% of the cars that those automakers have sold. So the thought with Tesla is, you're going to have tremendous growth, and you're going to have, continued, very strong margins. And what we're seeing now is Tesla is having to resort to aggressive price cuts. I think on average, the price cuts in Q1 were like 10%, yet their volumes were up just 4%. So typically when you cut prices, right, the price cuts at the very least due to elasticity of demand result in a similar demand response. And Tesla is not seeing that, right? And not only are they not seeing that, but for 4 quarters in a row now, their production has been more than their sales. And that's not a logistics issue or a delivery issue at the end of the quarter. For 4 straight quarters now, which is a record, that's a record trend. That means that there's just too much capacity of Tesla cars in the world versus demand. And keep in mind, they're not selling the cars they're producing. They're engaging in margin slashing price cuts that are more than the volumes that are resulting from those price cuts. And against that entire backdrop, 2 of their facilities, 2 of their quote unquote gigafactories, which is a name they made up, but nonetheless, are running at 20 to 40% utilization. So the point is, I think you're going to have a significant deterioration in their margins in Q1 when they report earnings next week, I think on Thursday. Wednesday, I think. It doesn't matter. The earnings are next week. You're going to have a significant deterioration in their margins, but it's going to get even worse in Q2, right? They've already announced massive price cuts in the US. They just announced price cuts in China. I think they'll announce price cuts in both Europe and they announced price cuts in Hong Kong, not China, but theoretically, I think they'll announce broader price cuts in Europe and China imminently. So the economics on their business, I think, are going to get even worse in Q2. And the problem with Tesla is, Elon Musk has like 130 million followers on Twitter, which is like a third of all the people in the United States. And a lot of those people are fanboys / in my view, cult members. So it's like everything he does or Tesla does or any of his companies is positive in their mind, right? So if they cut prices, it's positive. If they raise prices, it's positive. So I think a lot of people get confused because you have so many people saying how this is positive. But the reality is, if you're cutting prices and it's not resulting in at least equivalent volume increases, that's extremely negative, right? And the reason why every single automotive maker in the world has went bankrupt outside of Ford is because they've ramped capacity ahead of demand. And that seems like that's exactly what Tesla has done. So the reason why we're negative on Tesla is not because we have anything against Elon Musk, although he's of questionable character in our view, given he has a pathological problem with the truth in our view. And I can explain that. But it's really fundamental because, like, typically when executives have a pathological problem with the truth, like Elizabeth Holmes and Trevor Milton, regulators correct for that. But it's clear to us that Elon Musk can literally do whatever he wants and regulators will not do anything. So that's not any part of our thesis. We do not think the US government will ever do anything substantial to Tesla, no matter what they do. So our focus is on the competition and the units. And the reality is, they're having to cut prices. They can't sell out their existing capacity. The price cuts are not resulting in similar volume increases. And this stock is valued at more than the 7 largest next automakers combined, suggesting that they should be growing units, significantly every quarter. And the unit growth in Q1 is going to be 4%. And in Q2, minus, very aggressive price cuts, is probably going to be flat to down. So the point is this, their earnings are about to take a huge hit. And that's not what the street is modeling. Their margins are about to take a huge hit. That's not what the street is modeling. And because you have so much competition, you look at Consumer Reports or JD Power and reliability/quality surveys. Tesla ranks last or close to it. What question mark? The reliability rater out in the UK. Tesla ranks last in reliability. Full self-drive. Guidehouse ranks Tesla dead last in autonomous driving technology. Tesla said they were going to make their own batteries. Made a lot of promises at Battery Day. We now know that they're simply buying batteries from Panasonic and CATL. Pretty much every promise they made, the bulk of the promises they made at Battery Day, we now know were mistruths. He launched this Tesla Semi, and he said he was going to have a video of a 500-mile drive. That video hasn't come out, and we've seen multiple trucks of those towed. His brother just sold stock, I think $20 million worth of stock. The last time he did that, which I think was 2021, over the next 6 months, Tesla stock was down 50%. So the reason why we don't like Tesla as a stock is because it's grossly overvalued and competition is crushing them. And the competition is only going to get worse in the US. It's already crushed them, in China and the EU, where in China, their market share has fallen from 25% to 6%. In the EU, their market share has fallen from 35% to just under 10% and continuing to fall. And in the US, their market shares went from 75% to 50%. And GM and Ford are just getting started, as well as others. So I think the reality is, Elon Musk has gotten away with a lot, right? He's made claims that weren't true, et cetera. And people have valued them as such. Morgan Stanley currently values Tesla's, their insurance division at more than Geico. And their insurance division doesn't exist. They're giving them value for other divisions that they don't even have in the multiple billions. So I think as people realize that this company is overvalued, as people realize that they're not the leader anymore in EVs, as people realize that their quality is of suspect a condition, Edmunds has done a number of studies where they've looked at real world range versus claimed range. And Tesla is one of the only few automakers where most of its cars, the range is actually lower than what they claim it is. Everybody else, particularly Porsche, has real world range significantly more than what they claim. So there's just so many things to where I think people are just going to say, these other cars have better interior, similar or better real world range, significantly better service, and I don't have to be associated with, all of the issues around Elon Musk. And you're seeing that as their market share deteriorates, as they have to cut prices and it's not resulting in new units. And I think that the earnings are going to be bad. So that's a long-winded way of why we're negative on Tesla.
Yeah, no, and I see your points on that too. But one question I have for you too on that note is that Tesla recently, I think within the past year or so, got kicked out of the S&P 500's ESG index because the ESG is essentially for quote unquote green companies, right? So you would think I mean, the way that it's been portrayed, although I mean that's neither here nor there about how they manufacture these batteries and other things like that might not be viewed as necessarily green, but why do you think that that has kind of, I guess, hurt the perception of Tesla in your view? And yeah, I guess how do you view that view by the S&P 500 essentially just booting Tesla out of the ESG index?
I mean, I think it's hurt a little bit, but I think more importantly, Tesla allowing, or sorry, Elon Musk allowing a number of questionable characters back on Twitter. Um, uh, you know, um, a number of these kind of, far right, kind of questionable, characters. The rhetoric around, hate speech has increased. I think it was like a 500% increase in the use of the N word when Elon Musk took over. His comments around, when Nancy Pelosi's husband was attacked, and him putting out conspiracy theories around that. I think it's just, and his constant endorsement of, I think conservative, some would argue, conspiracy theories, I think has incensed his core constituency of liberals against the car. It's like we've said this in a note. Driving a Tesla car is kind of the equivalent of wearing a MAGA hat now, and I think that a lot of his core constituency just are turned off by that. And because now you have multiple other options where you don't have to buy a Tesla, but you can go EV. I think that that's really what's hurt him. I don't think it's the ESG thing. I mean, I was shocked at, if you look at the LA Times report that talks about the type of racism that was going on at the Tesla plant, and the allegations that Elon Musk simply sent emails saying, "Hey, be tough," where people were being told to go back to their plantation in the facility. Black employees, people were being called the N word. They were putting KKK tropes in the bathrooms, and instead of addressing it directly, they were told to have tough skin. I mean, I thought that was going to really hurt Tesla. You'd think that like some of these big asset managers, like the Fidelities or the BlackRocks, when they heard that, would move away from this guy, but it didn't. So I don't think it's the ESG thing. I just think this guy is impervious to being held to account for anything. It's like, these cars continue to wreck into, emergency vehicles on the road. NHTSA's been doing this investigation for years. He did a Paint It Black video in 2016 that we now know was completely doctored. The video was 3.5 minutes. If you watch the video, it looks like the car's driving itself. The video starts out saying the driver is only there for legal reasons. The car's driving itself. And we now know that Elon Musk directed it. And it literally took like 500 miles to do it. The car wrecked multiple times. It was completely doctored. Like, I think that's worse than rolling a truck down a hill. Trevor Milton's going to jail. Elon Musk is paying no price for that. So I just think he's impervious to, being held to account. And keep in mind, right? Trevor Milton rolled a truck down a hill, right? Nobody died. If you go to TeslaDeaths.com, it's been alleged that there's been like 20 deaths associated with autopilot, which I'm sure some people can attribute to that Paint It Black video. And yet there's been no consequence to Elon Musk or Tesla. So I just think these guys are above the law. So I don't think any of that one can factor into their analysis. But I think that the competition is a big problem. I think that the fact that you have so many other options, that better interior, equal or better real world range, and much better service is a big problem. And I think that him taking over Twitter and kind of showing his hand, if you will, with respect to his aggressively conservative views and the hate speech, etc., I just think has incensed a lot of people to his cars, and I think that's the bigger issue.
Yeah, I mean that's a whole nother rabbit hole we could get down of. But I mean, just from my view, I don't know if that's necessarily the case. I mean, Elon has kind of pointed out that he's he paid the most in taxes over this this past year than anybody's ever done in history. If he was super conservative, you'd think he'd probably try to find a way to get around that. And prior to this, him kind of taking over Twitter and saying that he wants to go the conservative route, it's been documented that he's, kind of voted the other direction in previous elections. But, I don't know if we're gonna.
This say it's been documented. I mean, he said that, right? I mean,
yeah. I mean,
so let me just give you a couple of things, right? So when Elon Musk purchased Solar City, in our view, we covered Solar City. It was on the way to bankruptcy, and if Solar City would have went bankrupt, that would have put a huge dent in Elon Musk's enterprise. And what he did is he showed a fake solar panel on the set of Desperate Housewives to sell Solar City investors on the takeover. That's not like something he promised that he didn't deliver on. That's just a mistruth, right? Elon Musk said he had funding secured to go private in the middle of a trading day, right? That's not something he, later delivered on. That's just a mistruth, right? And he did the Paint It Black video, which again, completely doctored. So what shocks me, it doesn't shock me anymore, but it still surprises me. It's like you see these things, right? He said at the height of COVID, right? At the height of the COVID pandemic, he forced his workers back to work. And then you had an explosion of COVID cases in the county they were in. And he said he was going to make ventilators. He's like, we're going to make ventilators, right? Ford and GM, excuse me, they repurposed their facilities to make ventilators. Elon Musk didn't make one ventilator, right? It went with the Flint water crisis. He said he was going to fix everyone's pipes. And then what did he do? He sent a couple of water filters to a few schools. My point is, this guy has shown a tendency to do horrible things. Yet people like you and others just simply say, well, I don't know if I agree with that. It's not, there's no question anymore, in my view. You can see these things well documented. He called the hero who saved those kids in Thailand a pedophile. These are just horrible acts, right? You don't force your workers back to work against a county order at the height of COVID. He did. He got away with it. You don't say you're going to make ventilators and then send a bunch of CPAP machines from China to hospitals with the Tesla logo on them. He did. He got away with it. You don't say you have funding secured to take your company private in the middle of a trading day. Anyone else who did that would likely be in jail. He did. He got away with it. So my point is, to say that, well, I don't know, it's just, you're just neglecting reality, in my view. But I've accepted that, he'll continue to do these things and he'll continue to get away with it. So I think the reason that the focus on the stock should be the competition and the earnings. And from that perspective, I think this year is going to be very bad for them.
Yeah, and I agree with you there. And I do think, he is somewhat of I guess we could call it like a marketer in a sense, where he's able to, kind of, make the narrative look a lot better than it is. I mean, I worked in some sort of industry prior to this where I could, I was analyzing the NHTSA laws and other things like that. And so when he markets, full self-driving and other things like that, that's obviously not the case and not true. And that's been kind of a big conversation in that industry as well. So, I get where you're coming from in that perspective for sure. But, you've been very generous with your time today, giving me a full hour of it and a little bit more. So I really appreciate you coming on here.
Absolutely.
Why don't you tell people where they could find you and what you got going on?
Yeah. So, I mean, we post to Twitter, but the bulk of our research, 99% of what we do is published via, our GLJ research. And it's unfortunate that we go on TV so much about Tesla because we cover 19 other stocks, all of which we have similar interests in. So hopefully people can see us for not just Tesla. And one other thing I'll highlight is a lot of the Tesla naysayers talk about this TipRanks rating website, but I think that's the most egregious website, probably one of the most egregious websites online, because it's like what that website does is they take your public recommendations, which we don't send them our research. So all they see is our Tesla notes, and then they try to basically rank you versus everybody else in the market. I mean, there's been times where they've had us covering stocks that we don't even cover. So I would caution people against, looking at tip ranks as a means to rank an analyst. But GLJresearch.com is where you can find us. And we sell our research via subscription. We've been doing this, research since 2006. And, we're value-based with a top-down and bottom-up combination approach to complement each other.
Awesome stuff. So I will link all that inside of the show notes. So if you're listening on YouTube, you could look at the comments below, or if you're listening anywhere you get audio podcasts, just check out those show notes to figure out where you can look at all their research and connect with Gordon on Twitter. So Gordon, thank you so much, man, for coming on. I'll have to have you back on in sometime soon.
Absolutely. Thank you.